The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Happy Monday. It's Monday, July 23rd. It's 11 o'clock, and we're excited to be with you. And my name is Dave Vick. We're going to talk about how to position FIAs in a low interest rate, high volatility market. Just with people struggling with low caps, I think that's the issue really, is the low caps. Are you struggling with low caps? And so we're going to talk about that. But glad you're here again. My name's Dave Vick. I'm a marketing consultant with Dressander & Associates BHC Marketing, Futurity First Insurance Group. And just a little advertising, our next academy where we talk about the ABC workshops, ABC planning process, financial snapshot software, Steve DeJohn's Retain Your Gains GPS, Steve's email marketing system that's working real well, and Red Hawk and more. We're in Philadelphia. Call your marketer. If it's BHC, call 800-201-0224 and Dressander 800-526-0319. Get yourself registered, because we'll be out in Philly having Philly cheesesteaks and talking about how to build your business. And so it's going to be a great time. Little ABC tip for the day, and stop listening to present. Listen to diagnose. Listen to understand. Listen for the pain. Just listen. We get in a habit of asking a question. As soon as somebody says anything that we can present to, we present to it, and we need to hold back a little bit and learn the art of asking questions. If you want to learn the art of asking questions, just call your marketer and get our webinar. My webinar, I've talked a bunch of times on the art of asking questions, and you'll be sure to get some good input there. So today's topic, the having trouble with low rates, but really how to position FIAs in what is a low interest rate, high volatility market. Remember, this is the question. Where do index annuities fit in a client's total portfolio of assets? That's the question. It's not, I don't think it's a matter of caps. It's not a matter of interest rates. It has both of those things are combined are part of the equation. But where do index annuities fit in a client's total portfolio of assets? That's the question when you're thinking about, low caps and how they fit in, and what do we do? And interestingly enough, just reading some material recently, that in the last 6 months, the annuity business has taken kind of a hit, and nationwide, between fixed annuities, variable annuities took a big hit, but index annuities were the only annuity that rose in sales. Very interesting. When I have agents saying, can't sell them because of low caps, or I'm struggling to sell them because of low caps, that they are on the increase. Also, if you want to read Insurance Newsnet magazine, Insurance Newsnet magazine has some real interesting articles about why people buy annuities. It's a study and an article by Stephen Morelli, and it's a LIMRA annuity research study that you're going to want to get your hands on. Things like, age at purchase. When do people purchase indexed annuities? And interestingly enough, the largest demographic that purchased them, 50 to 59, age 50 to 59. And the largest indexed annuity demographic is kind of, 250 to $1 million. 51% of those who purchased indexed annuities had household assets, investable assets, 51% now, from $250,000 to $1 million, $250,000 to $1 million. Very interesting, very, very interesting. And it was also interesting that the strength of the company was a concern for 68% said it was a concern for buying index annuities. Projected return was 66%, but tax-deferred benefits were lower on the list. And So you're going to want to get this study. It's very insightful, and it's Insurance Newsnet Magazine, July 2012. So I think you're going to really want to get a hold of that. How to position then FIAs in our current market. I'm going to give you about nine ideas here, and we're going to talk about a few of them. You position them between low interest and high volatility. Just think about that. Low interest rates, where the interest rates are today, we're going to talk a lot about that, and then high volatility. That's where they fit in as a protected asset option. In other words, an option to safe money or other protected assets, CDs, mainly savings accounts, those kinds of protected asset options. That's where we belong. For those that want guaranteed income in some part, all of their income planning strategies. For conservative investors seeking relief from volatility. I mean, it wears on people, the up and down. We're going to talk about this a lot, but in conservative investors seeking relief, you have to listen. That's why you got to listen to your prospects and listen to what they're saying. And a lot of them are saying, man, the market's going up, but I'm scared. A lot of things are happening out there. As an alternative to dependency on Social Security, we're going to talk about that just a little bit. And for those seeking protected annuity returns rather than variable annuity returns. So we protect the returns or we don't protect the returns. For those seeking liquidity in our red money column, in risk money. So for those who want that red money column to be liquid rather than moderately liquid, and I'll explain more of that. To escape the impending bond market collapse, and that's on its way somewhere in the next year to 3 years probably. That's going to happen, or maybe 5 years, between yellow money and red money, and so that's the perfect position, which is between low interest and high volatility. Number 1 and number 9 are pretty much the same thing. So how to position FIAs. What does a CD holder remember? Just think about what a CD holder remembers. And this is a struggle for producers. And I'm just going to frame our time a little bit with some of this thinking. What does a CD holder remember? We'll go over that just a little bit, but they don't. They're in the 0.5% rates or 1% rates now. But what do they remember? Why are they reluctant to move? Why are they reluctant? Why do they have a bias, a status quo bias tendency, and to just stay put? Well, because they remember 5% rates, 7%. Some of them remember. Older people remember 15%, 13, 14, 15% rates, but it just didn't seem like so long ago that 5 to 7% rates were that far away, especially 4 or 5% rates. They remember them because they were fairly recent. In a similar vein, what does an annuity producer remember? An annuity producer remembers, and this is one of the reasons that in our minds our beliefs matter. I mean, beliefs really matter. What you believe about something can prevent you or help you to make a sale, an annuity sale. So what annuity producers remember are caps, higher caps. They're just like CD holders, just like that guy. Annuity producers remember what? 7% caps, 6% caps, 7% caps, and they were just around the corner. They were just months ago, and that's what we really remember. So we have a hard time, just like we kind of laugh at this guy saying, how come he can't get past his CD rate mentality? Because he's waiting for those rates to come back. He's just waiting. They're just around the corner, of course. He has that memory. And annuity producers are the same thing. They remember. They don't like that 3% cap or 2.5 or 3.5 or 4% cap because they remember the 7% cap and 6% cap, and it wasn't that long ago. Just like the mind, if you just I hope you get this. Just like a CD holder, you're just acting just like them. And so we have to figure out where to position, really to position, index annuities. And it is truly between the low interest rate and and the high volatility of the market, we've had a luxury over the last 10, 12 years of beating the market. We've had an incredible luxury. And but I got to tell you that you know this to be true, that index annuities were not designed to beat the market. In no way were they designed to beat the market. They were designed to beat CD rates. That's what savings rates. That's what they were designed to do. So we've got to get out of this mindset and this presentation of, yeah, we beat the market, all that kind of stuff, and we did, and we can use it, but mentally we have to say, you know what, we're the middle ground. We have to own that middle ground, and owning the middle ground will get you a lot of production, and you'll be part of the people selling with those that are increasing in annuity sales because of low interest rates and high volatility. Some people are getting it. That's why index annuities are a great proposition right now. See, we remember this. Index annuities, FIA, look at those average returns. Can you see those average returns right here? Look at these average returns, for 5-year annualized periods. Look at that. Even the 4.19, that was great because the market lost money, and we're saying, yeah, we beat the market. Look at this. Yeah, we beat the market here. Well, we didn't beat the market in those 5 years. And, we were close here. We beat the market here, beat the market here, beat the market here, and we were close here. So a lot of those, we look at these and look at the return range. Look at the top end of these return ranges. That's what we're stuck on. We just remember these returns versus the market. And we remember the caps, and we think, oh, man, we can't sell them until we get those back again. Not true. That is only in your mind. Only in your mind. You're thinking that you're in competition with this column right here. And that couldn't be farther from the truth. You are not in competition with that column at all. So you are safe money competition, protected money strategies competition. That's who you're in competition with. You're in competition with CD rates. Look at this chart from 2002. This is only above 4% from 2006 to about 2008 and coming down. And now look at where they are. Below 1%. And what does the Fed say? They're probably going to stay below 1% the same. In fact, they're talking about negative rates, and banks are talking about negative rate CDs. We're going to guarantee things are going to get so bad that we're going to hold on to your money. We're going to charge you for it, just for safety. Look at these. This is what CD holders remember. Look at these. These are rates. Let's take July 2002, and we go back and look at 2006, 2007. They remember 2007. It wasn't that far ago. This is what long ago. This is what they remember. Even these 4% rates, this is what they remember. And they hold on to them. And just like you remember it. But look at it now. This is reality. And you have to build reality into your presentation, reality. In fact, you got to talk to people about reality, because look at this graph. Look at these low interest rates here. Look at these higher interest rates here. In fact, here's what they really remember. Look at these 82. Look at these 15, 16% rates here. Incredible. Some people go back to that and say, yeah, they're coming again. Yeah. Last time you saw these kinds of rates, do you know when that was? That was in the 1890s. The 1890s. These are a long way off, these types of rates. But in our minds, we are like CD holders. Look at the CD rates versus inflation. The dark blue line is the CD rate and the inflation rate. CDs beat inflation. They remember CDs beating inflation. And then you actually look at inflation with CDs and adjusted returns, and you begin to see, well, it wasn't that good. If we take a look at, being spending a lot of time less than 2%. In fact, there's a number of years there. There's probably 4 years there where there were a negative return in that graph. And then here's some other key rate kind of thinking. Our current federal funds rate, the rate that, you can borrow between banks overnight, 0.14. That's incredible. The Federal Reserve target rate, the prime rate, unemployment rate, and the LIBOR rate, 0.251 month. And for those of you, just a little education, the LIBOR rate is the average interest rate estimated by leading banks in London that they'll be charged if borrowing from other banks. It's usually abbreviated to LIBOR. It's the primary benchmark for short-term interest rates around the world. Get this, LIBOR rates are calculated for 10 different currencies and 15 borrowing periods ranging from overnight to 1 year and are published daily at 11:30 a.m. in London by Reuters. Many financial institutions, mortgage lenders, and credit card agencies set their own rates relative to it. At least $350 trillion in derivatives and other financial products are tied to the LIBOR. Get that rate, 0.25, 0.45, incredibly low. And so where do we go? What are our rates? When you think about these kinds of rates, let's also talk about the bond bubble. This is an article all the way back in, because people talk a lot about bonds. Number one, are bonds safe assets? Well, they're probably more safe than stocks, unless you held Enron, WorldCom, Lehman Brothers bonds. But this article in Wall Street Journal called "The Great American Bond Bubble," talked all the way back in 2010 about what was going on in people putting money in low interest rate bonds by the trillions. And the bond market is much greater, much larger than the stock market. And so they're talking here that if a 10-year interest rate, which are now 2.8, of course we're lower than that today. This is 2010, lower than that today. Rise to 4%. Just think about if they rise to 4%. Now, let me ask you a question. Could interest rates rise over the next 5 years, 3 years, 5 years to 4%? Ask yourself that question, and you might begin to think, yeah, they could, 5 years from now they could be 4%. As they did last spring, bondholders will suffer a capital loss more than 3 times the current yield. A capital loss more than 3 times the current yield. Just Google Wall Street Journal bond bubble, and you're gonna get this article, and it's really gonna be a great insight to bondholders who you're gonna want to help out of bonds and into a bond alternative in the green money column, indexed annuities. That's where we belong. Bonds are in the red money column, and we're in the green money column, and they're a bond alternative. But they're not gonna lose, principal like this is going to happen to bondholders. Just think of, people think if I get a fixed rate or a cap rate of 3.5%, 4%, and how do I measure 4% or 3% versus an interest rate that are currently and that may go up? In fact, you could think of getting a 2.9% average yield from an Athene 5-year guaranteed annuity, where the first year I think is 3.7, the next years are 2.7, something like that, 2.9, 3.9, 2.9. Just call your marketer and they'll get the specific rates, but they average 2.9%, and Equitrust at 2.7%, and even American Equity at 2.3%. You'll see is more attractive than what I'm giving you. And an average cap of 3.5%, I mean, come on. And in the Nexus product that you can get more interest out than potential than anybody out there, any asset, any annuity out there, and you have 2 years, 2-year windows, and I'll show you some more assets. But anyway, think of interest rate progression. If interest rates were going to go up 1% a year for the next, or just stay at 1% a year for the next 3 years, in fact, they're talking about lowering interest rates. Let's just say they're 1% now, and they're talking about negative rates. So let's just, and the Fed say they're not changing them. They're not raising rates till, after 2014. And then, so let's just say they go up a whole point in 2015, a point after that. So the total of the 5 years is 8%. Divide that by 5. That's an average 1.6% rate. Change that last year. Let's say the last year jumps up to 4%. And so it's an average of 1.8. And let's say that it changes, even goes up to 5% that last year, because we only, boy, interest rates are really going to rise. Well, that's an average of the 5 years of 2%, even with a jump, a huge jump to 5%. Well, an average of 2%, well, I just told you 3 products that beat that. And then you have your potential of the FIA to beat that, even in some 5-year contracts, short-term contracts that can beat that at 2.5%, 3.5%, 3.5%. Those are low caps, but that's what we're competing with. This, what you're looking at on the screen, this is what we're competing against. So and you have a 2.5%, 3.5%, 4%, and Athene has an 8-year contract with a 5.5% cap, you need to call your marketer today and get a hold of that product. An 8-year product with a 5.5% cap. And that's part of the answer to your struggle here. You're gonna ladder some maturities at 5 years. You know, at 6 years, Lincoln National has a good 6-year product, and I'll show you a couple of those ideas. So you just want to make sure, though, that you're not competing against the returns of the market, but you will, I'll show you, I think, begin to realize that you're competing against this, and that's the next 5 years, and that's what we're going to think about. And then we have to think about the market. In my book, Bat Sox Vegas, Conservative Investing, I talk about paradigm shifts in the market and what's happening. If you can just imagine, you know, looking back from the day Reagan in January 1980 took office, you stood on the Dow and you look backwards over that period of time, and you see kind of a gradual rise from 1932 to 1980. And it had some down periods, you know, from 68 to really to 82. There was a bear market, but look at that graph, and you see kind of a you know, foothills instead of mountains, you know, gradually rising up. And then what would happen, you know, when you stand looking backward from Obama in 2009 and look backwards? Look at the difference in that graph. That's the last 20, 30 years in the market. And then the question is, you know, what happened? You know, I call it the M times or M generation, and you're looking at that dramatic M shape, you know, in the market. You're looking at this M right here. If you stood where Obama got elected and you look back, you really wouldn't, you know, on that Dow line, you really wouldn't see anything because you had this huge hurdle right here. And the question is, and I ask it in the book, the question is, and this is what we're selling against, is this volatility going to continue going forward? And if so, for how long? Has there been a paradigm shift in the market? And if there was, what could have caused that paradigm shift? Because this graph looks a lot different than this graph. So is this graph the new norm, the new paradigm? So that's the question. Is the volatility experienced by investors in the market today an investing paradigm shift? So what was the connotation of gambling back in the 50s, 60s, and 70s? Was it positive or was it negative? Gambling was negative. Come on, unless you loved the Rat Pack, which most people did, but you know, they wouldn't invest in them. You know, it was a negative connotation. And so let's think about what we do with our current investing. Think about invest. Just the term invest in the dictionary is to commit money in order to earn a financial return. To commit money in order to earn a financial return. It sounds like you're committing a sum of money, you're going to get it back plus a financial return. Let's take a look at gamble. To play a game for money or property. To play a game for money or property. To bet on an uncertain outcome. To stake something on a contingency. To take a chance. Now, what's the difference between these two? Is that we're gambling with everything on the gamble. And let me ask you this. What do most people's 401ks mostly resemble? The word invest or the word gamble? The word invest or the word gamble. Now, it's also interesting in Ed Winslow's book, Blind Faith, he talks about this paradigm shift that's gone on in the last 20, 30 years. Gambling this was back in 2003, gambling a $90 billion a year industry. 1988, only legal in Nevada and New Jersey, just 2 states. And in 1994, operating in 23 states. So we had 6 years, the next 6 years, we went from 2 states to 23 states. And then 6 years later, so 12 years later from 1988, 34 million people visited Las Vegas in 2000. In 2000, over 127 million people in casinos nationally. In 2003, operating then in 48 states. In 15 years, we went from 2 states to 48 states. The industry take per participant is $750 or $250 per person in the U.S., per every man, woman, and child in the U.S., $250 per person. What has changed? I mean, now we have, online gambling. We have gambling on the TV, on cable networks, where you have, Texas Hold'em tournaments. Donald Trump had his a gambling champion, a gambling celebrity on his Celebrity Apprentice. I didn't even know there were, gambling celebrities, and which is incredible. I mean, the whole thing has changed. Our culture has changed to gambling. Is kind of exciting. It's kind of risky. That's the kind of culture we have. We fly fast and and free and we risk. I mean, that's who we are. That's kind of cool. And so, how does a conservative investor invest in these times? In their mind, in their thought process, they may have this concept of gambling is cool. Gambling, I love. Look at the casinos. Look where they're filled with. I mean, look at them. They busload seniors in there, daily, hourly. I mean, and these are conservative investors and boomers who are conservative investors. And Vegas being a family spot. Much more about 10 years ago than it is today. They're making a big push for that, but it happened, and it changed the way people looked at gambling, the way people looked at Vegas, and we have this cultural change, this shift in our attitudes towards gambling. And then take a look at that, and then take a look at this. So in '78, Congress enacted, this is out of my book, Bat Sox Vegas, Conservative Investing, enacted a change in the tax code which enabled much of the change to speculation in our investing culture. So it was a 401k change. It took effect in 1980. By 1983, more than half of large companies were setting up 401k plans, a little more than 17,000. But halfway through the 80s, think of this, there were less than 8 million people investing in 401ks, about 100 billion invested. Now think forward. Remember, 48 states, 2003, in gambling, and our perception of gambling has changed, and we're in the market because the tax code was changed to make 401ks available to us, to everybody. So now there's 70 million participants and over $3 trillion invested. $3 trillion invested. And so the question is, the average American in the 70s was invested in the market, and by 2006, it's a cultural norm. They went from savings in banks to investing in mutual funds just because of the availability. Now, there's got to be a correlation between our society's acceptance of gambling, because, again, you would not take the normal person in the 40s, 50s, 60s, the average person, to gamble on the stock market was averse to them. I mean, even in the 70s, a lot of the investing in the market was, high dividend investing. It was, blue chip investing. It was bond investing. And so now, all of a sudden, in the last 30 years, the stock market, mutual fund investing has really, caught on. So investing, the other thing you have to realize is that our technology has changed. Investing is done at the speed of information. We know things overnight. We know things in minutes, in Greece, in Syria, in Egypt, in Iraq, Iran, in Afghanistan, in London, in Germany. From Los Angeles to New York, we know things instantaneously. Investing now, more than ever before, is done at the speed of information. And the speed of information is the speed of the Internet. Thank you, Al Gore invented the Internet. Glad he did. And just kidding, I'm not political. And now we invest at the speed of the Internet, which means millions are made or lost in nanoseconds. And then in the options, market, the nanoseconds, just being able to, the market makers make millions in nanoseconds. And so it's a matter of when are trades made, how much time do I have before I push that button and the trade is actually made. Information is king, and the speed of the Internet and those nanoseconds count. And so the volatility, I ask you, is that going to be the same? Do your clients want to keep going through this kind of a cycle with all of their money? I mean, this is what we're talking about in volatility. Look at the psychology of a market cycle. Look to the left, and you start with disbelief, and this rally will fail like others. Hope, the recovery is possible. Optimism, this rally's real. Belief, time to get fully invested. And now the market's climbing. See that cycle? Market's climbing. Thrill, I'll buy more on margin. Got to tell everyone to buy. Euphoria, I'm a genius. We're all going to be rich. Then some complacency sets in as the market starts its normal downward trend. We just need to cool off for the next rally. Anxiety, why am I getting these margin calls? This dip is taking longer than expected. Denial, my investments are with great companies. They'll come back. Panic, shoot. Doesn't say that, but shoot. Everyone is selling. I need to get out. And anger, who shorted the market? Why did the government allow this to happen? Of course, we go and blame it on the government, right? Depression, my retirement money is lost. How can we pay for all this new stuff? I'm an idiot. Back to disbelief again. This is a sucker's rally, and we'll fail like all the others. And so we go through those emotions, and the struggle is that the volatility of the market has you look at that graph that I showed you of the Dow in the last 20 years, and it has increased. The volatility has increased, and people are living on pins and needles. Yeah, they want to grow. They want to get there. They're afraid of what's going to happen overseas. They're afraid of what's going to happen in all kinds of areas. So that's why the ABCs, and in asking that question, where do index annuities fit in? They fit in between, cash and the growth column. That's where they fit in. They fit in between CDs and, the red money column. So, that question is the volatility experienced by investors in the market today an investing paradigm shift? Well, what do you think the market will look like over the next 10 years? Before you answer that, think about national debt at $15.9 trillion. Have you ever sat and watched that national debt clock? It scares the tar out of you. Absolutely scares the tar out of you. If it doesn't, it should. Just Google national debt clock, and you'll see it. And it just keeps spinning and spinning and spinning. And do you think that's going to change? Do you think with all the government, gridlock, Republican, Democratic gridlock, that the election is going to change it? Do you think anything's going to change there? I don't know. Maybe it's not going to change until things get so bad that they have to change, like has what happened in Europe. Is that what we're headed for? And the question is, ask your client that. Ask your client that. Social Security bankrupt date by the Budget Office of the U.S. government predicts it being out of money at 2022. 2022. And so then what are they going to do for income when the government, Social Security system is, and what's going to happen to our taxes? What's going to happen to the system for the boomers coming in? What about the cost associated with Obamacare? 20% of our economy. And what's going to happen with that? The unemployment rate, over 8%. And if you take those that have recently run out of benefits, they've extended their, used up their long-term benefits and are now taken off the rolls, the estimates are 15 to 22% in terms of unemployment if you added those people back in that we can't give benefits but are still out of work. Greece, Spain, Italy, Ireland, keep going, right? What's going on in Europe, in the debt crisis in Europe? And are we headed that way? And are these things, you look at these 5 things, are they more conducive to more volatility in the market or less volatility in the market? Has the speed of information and our propensity to gamble, on really with our kids' future, is our propensity to gamble, all these things, is this a paradigm shift in our culture that affects our volatility in the market? So if there's a bear market that comes, this is why the ABC model, and this is where positioning comes in. If somebody has $500,000 and they have 10% in cash and 90% linked to the market, in those first 10 years of the 21st century, they would have lost $101,000. And tell me, the next 10 years, Are they going to be different than this? Substantially different than this. And ask your client that question. And we have this graph. You can get it. Or, you know, are they going to put 60% in green money? That's where you position them. This is how you position them. 60%, we get out of the volatility. We're going to make a little more than the safe money. And this is our retirement column. And they make $96,000, which is a $198,000 difference, a 39% difference from where we were before, from this to this. So if you're thinking, remember about that interest rate progression, you know, 9% and 10%, 2% average. If it goes up to 5, then here's some annuity solutions. Just think of it: laddered maturities of index annuities to 10 years. So starting at 5 years, throw in an Athene or an Equitrust or American Equity fixed rate at 5 years. You know, and then go to Lincoln National with go to Lincoln National with a 7% point-to-point cap over 2 years on their 6-year and 8-year product. So over 2 years, if you think the market's going, 7%. That's 3.5% a year. That's a lot better than 1% a year over the next 2 years. BPA with a 3% bonus and the 8-year contract, and then recalculating that every 2 years. That's a good option. A theme with the 5.5% cap on 8 years. So you've got some. Here's the 5-year and the Equitrust 5-year guaranteed products that yield 2.9, 2.7. These are the options. Listen to me. No, they're not 5% anymore. They're not 3% anymore. They're not 4% anymore. But the 5-year option being at 2.7, 2.9, and a cap. And by the way, the caps are just going to be designed to earn that 3% over the next 5 years. Go to the Allianz Pro V1. Go to the Equitrust. Go to short term and maybe make then your longer term that a Nexus 8 years. And even the Lincoln 8 years, or the American Equity 10 years. Add those in with an 8% bonus and a 3.5% cap. And then as interest rates go up, you can start to pull money out of the longer term through 1035 exchanges or qualified transfers and put them into shorter term, or better paying, higher capped annuities over a period of time. So if you ladder them 5 to 10 years, you've got really covered yourself with potential for the client. And we've positioned ourselves in the right place. We've positioned ourselves right here where we should be. 60% or whatever, that green money column, green money asset, that's where we want to position ourselves. So let's look at those: 1.8% rate, 1.6, 2%. Those are average over a 5-year period. These are some solutions. This is where we put. This is where we put ourselves. We put ourselves between low interest and high volatility. The market is high volatility. Yes, it may continue to go up. And, if you believe Russell Napier, it's going to be half of what it is today by 2014. That's incredible volatility. Has there been a paradigm shift? So position yourself as a protected asset option. What are other protected assets? The annuity is a protected asset option. Get out of your mind old rates. You're sounding like an old senior. Deal with reality today. Reality today is a 0.5% to 1% on protected asset rates and high volatility in the market. And then position it for those who want guaranteed income options. For conservative investors seeking relief from volatility, they are seeking relief when they see the ABC and the green money option being that in-between ground, that bond alternative, that CD alternative. Because I have an advisor friend whose client lost $1.9 million in Lehman Brothers bonds in 2009. Who'd have thought that? And tell me that's not going to happen again at some point with the bond bubble. And as an alternative to dependency on Social Security for boomers is an iffy proposition for those seeking protected annuity returns rather than variable annuity returns. In other words, you've got an annuity, and you're used to that annuity structure, and yet your account balance goes up and down. Would you rather just have, maybe even a lower rate of return, but be able to keep it? For those seeking liquidity in the red money column, that's the key too. you want liquidity in the red money column, you want the growth column, but if there's a variable annuity in there and it's moderately liquid, you want the moderately liquid asset to be in the green money column. So switch it back to the green money column and use the red money for liquidity. So in that one example of 10-60-30, you'd have 40% of your assets liquid, all the time. If you could get and take the VA, turn it into an FIA, a fixed index annuity, and you'd be better off. To escape the impending bond market collapse. That's pretty strong language, but something's going to happen to bonds. It's a huge market, much larger than the stock market. And so annuities are that bond alternative. And the way they structure how they plan for them, they buy a block of bonds and they just keep them for the duration. When they keep them for the duration, then they get their money back, and it's just like safe money alternatives, and they manage that bond portfolio. But the company takes the risk. There's no sense for the client, prospect, taking the bond risk. Let the insurance company take the bond risk. And then between yellow money and red money, and that's exactly where we belong. Between yellow money, low interest, and red money, high volatility. And you got to paint the picture as I did today. If we had a paradigm shift, look at the things that have gone on in our markets. Is it going to change? You look overseas, you look at the spending, you look at all these things in are the next 10 years going to be significantly different than the last 10 years in terms of volatility? If you want to take some of that volatility out of your portfolio, then choose a green money alternative in index annuities. So we'll go over a lot of this and the ABC workshops in Philadelphia, and we'll talk about the ABC planning process. You'll get a lot of those things just firsthand training in Philly. So join us August 22nd to 24th, and call your marketer. By the way, see those numbers down at the bottom? You're going to want to call. You're going to want to call your marketer to register for that academy. You're going to want to go to the websites, but you're going to want to call your marketers and get the Athene, get the products, get the Allianz, get the Annexus products, great products. And in this time frame, you have to think differently that you've thought of in the last 5 years, because we've had that privilege of beating the market, but it's no longer there. They actually will do what they're designed to do, what they were originally designed to do from the beginning, which was to be that middle ground between low interest rate and high volatility and the fear, the scary movie, if you will, of the next 10 years. And that's where we position ourselves. And so that's why index annuities have risen in sales. And if you're not part of that rise, you want to be, because you want to position them right. You want to think differently than you're thinking now and believe something differently than you're believing now. So call your marketer and get some of the product information updated, and get yourself registered to come to the training and get all our sales tools on Planning with ABC sales tools. That's on the planningwithabc.org website, and take people to the planningwithabc.org website like a lot of guys do, and they show the videos there, which show just what we've talked about, the position of the indexed annuity. I want to thank you for being on with us today. Our agents are our customers, and without your success, we won't succeed. Got to change your beliefs, and you will succeed. Have a great week. Take care.